Okay, now I'm going to share my screen. All right, can everybody see the PowerPoint presentation? Fantastic. All right. So the class is entitled Twin Cities First Time Home Buyers Class. Don't make these costly mistakes. So hopefully you can learn vicariously through me and through the information and make the best decisions with regards to home ownership. So as a first-time buyer, because you've never done it before, you might feel concerned, stressed out, intimidated, anxious, uncertain, and for sure the last place, not sure where exactly to start. Now, the average person buys a home maybe 3 to 5 times in their lifetime, so it isn't something that you do on a regular basis. And the laws are always changing and the programs, so it can be complicated, and that's why you seek out somebody that can guide you properly. I'd mentioned earlier a little bit about myself and my background. I work with Remax Results as my broker. I started selling homes right after college. I graduated from St. John's back in 1986, and I worked the entire metro area. I work both sides of the river, and I work with buyers, sellers, and investors. And I also work with a multitude of different mortgage companies so that we can match you with the right program. You can check me out. I can provide you with references. You can Google me, find out all about me. And what this shows is what a realtor does in the background. So we like to make the process easy for you. And in the background, things that are happening that you might not be aware of is everything on this sheet. So there's 111 things that we've broken down that we do that you might not be aware of. Part of working with an agent, if you were to work with an agent, is that at material contact of having a real estate discussion, they're going to show you this, which is the agency discussion, and it explains the roles of the people that are involved in the purchase. So there's somebody that represents the seller, the one with the sign in the yard, somebody that represents the buyer, somebody takes you over to that house, and then sometimes it's the same company or the same agent that are doing both, and that's called dual agency. And sometimes we just do paperwork. So in the event that, let's say you wanted to buy from a relative or a friend and you didn't know how to put the deal together, then we would be acting as a facilitator. So there's no representation, but we're going to do whatever you've come to an agreement with and make sure that the paperwork matches it. On the bottom, you see in big bold letters 76 to 80 here that this is a resource for you to do research on registered sex offenders if that's important to you. There's a phone number and a website. That is one thing that a seller does not have to disclose to you. So somebody could have moved in right next door to them. They knew about it and they chose to move because of it. And then later you moved in and you were unhappy. You wouldn't be able to have any recourse against the seller because all buyers are given this phone number and website as a resource. So it's up to you to decide if that's important. And if it is, then you would check that out. Also, before viewing a home, there was a lawsuit that occurred and that was settled last August. And part of working with an agent requires you to either sign a showing agreement or a buyer representation contract. And so this is basically the standard form that's used. You see our stamp in the corner where it says Remax Results, but it would be the same if it was Edina Realty or Coldwell Banker Burnett or EXP or Keller or whatever. So these are the Board of Realtors forms, and these are meant to match the lawsuit. And basically what happens is that we have to have an agreement with you with regards to representation before we can continue to work with you or even show you a home. If you just wanted to look at one home, then we could enter into what's called a showing agreement before we moved on to the buyer contract. But something has to be in writing before you can view a home. Now, the only case where that's not applicable is if you walk into an open house. So that's a change. These forms and the requirement for signing them is different than in the past, and it happened in August due to a nationwide lawsuit. So it's not me, it's not Remax, it's the new way real estate's being done. One thing that we can do is data mine and give you data. So this is the most current. The website is mplsrealtor.com. The data is a compilation from the website Northstar MLS, which is where all of the homes that are listed by agents are put on for available for sale. When you go out and you look at a site like Zillow or Remax.com, for example, or Realtor.com, they're all redisplaying the data from the North Star MLS, our multiple listing service. From that, these reports are created. And this shows the Twin Cities and slightly beyond. And I want to highlight a couple things. The third one down is the median sales price. So that's your data set in the middle. Averages can be skewed by very expensive or very inexpensive homes, but the median is a good representation of data because it's in the middle. And what we see is a year ago, homes improved in pricing from 386.5 to 400,000. That's almost a 4% increase. Smoothing the data over 12 months, you can see it went from 374.7 to 385, about a 3% increase. So home values are appreciating throughout the Twin Cities. Now, it's not double digits. It was double digits when interest rates were 2, 3, 4%, and we had a very crazy real estate environment. Today, we have a steady and I would say strong environment, more buyers than sellers. That's why we have homes appreciating. And if it was the other way around, you would see them coming down in price. If you look at percent of original list to sell price, you see that homes are selling at almost 100%, 99.8%. So being that it's a seller's market, not a buyer's market, the sellers are able to, if they price their home appropriately, are able to get pretty close to list price. There's absolutely a correlation with pricing and market time. So if a home has been on for a while, it probably is overpriced. And in that case, it wouldn't sell and they would have to reduce it. But assuming accurately priced, very close to list is what they'll get. We have 2.3 months worth of homes for inventory, which means after 2.3 months, if we didn't add another house to the mix, we would be out of homes at the rate in which they're selling. So again, we don't have enough for the numbers of people that want to buy homes. Part of that's the time of the year. We're in the busiest time. We're in the spring market. If you're looking to buy a family style home, meaning 3 bedrooms or more, it's probably going to be timed by a seller that's looking to get out of the schools when they're over, meaning May, June. So February, March, April, with the closing in May and June, typically happens with family style homes. That's when the majority of that business is done. And then it picks up again in the August through September. Again, timing with school beginning and school ending. If you're buying a condo or a townhouse or an investment property, not so much because school isn't the main driver. But family style homes, school is the, not disrupting the kids during the school is important, especially if they're moving different school districts. If they're moving intra-school district, not as important because they still see all their friends. But if they're leaving a school district and starting in a new one, nobody wants to do that midway through the year. So what are the steps to home ownership? Well, one is to come to a class like this to learn the process. Then you're going to move on to a mortgage lender of your choice and get underwritten for a loan. Now you can get a pre-approval that's light, meaning they enter the information in the computer, they push a button and you get an automated approval. Or you can have a hard approval, which is underwritten by an underwriter, where they have physically validated your pay stubs, your W-2s, your bank statements, your asset statements. Of the 2 types of underwriting approvals, the full underwritten approval that's reviewed by the underwriter is in your better interest because there aren't going to be any surprises. You're just waiting on the title work and a property. Whereas with regular pre-approval, if there's something that wasn't disclosed, not intentionally, but not properly, then you may be underwritten differently than you had hoped, meaning you get less than you think you could. So we don't like surprises. We want you to be solid. And if we end up being involved in a multiple offer, one of the advantages that you would be able to present is that my file is fully underwritten. You don't have to worry about me if you are fully underwritten. That's how you would present that or your agent would. The types of loans depends on where you want to buy and your status, meaning conventional loan is open to everybody. A VA loan is only open to veterans. FHA is open to everybody. And then there's another one that's not on here. It's called USDA. That would be if you're in a rural area where you can utilize that program. You can't really use it in the city, but you can use it on the outskirts. So there's another type called USDA. You may be utilizing down payment assistance programs. An acronym for that is DAP. And that's probably why many of you are here tonight, is to learn about where can I get some free money, either in the form of a grant, a loan. How can I utilize that? Because I'm only going to be a first-time buyer once. I want to get whatever is available to me. So we're going to cover that here very shortly. So once you get your mortgage figured out and you're approved for a certain amount, then we set up your house hunt. So we go into the North Star MLS. Remember, that's the source. We put in your minimums. For example, I want 2 bedrooms, 2 baths, 2-car garage into the communities in which you might have an interest. So I want to be in Woodbury, Cottage Grove, Newport, wherever it might be. So we set it up broad, we set it up with the minimums, and then we show you what's available today. And then we set it up so that you're getting automatically new listings as they should appear on a daily basis. So every day there's another house listed, and if your parameters match that, you're going to get that over in your email once your auto search is set up. So it's very efficient. And then from your list, you self-identify what you want to see. We review the listing with you over the phone, and then we go ahead and coordinate schedules to view it. So it's much easier than it was when I first started out. When I first started out, we had something called the MLS book. It was like a telephone book, and it came out every other week. And it was one little picture, and it was in black and white. So you had to spend a lot more time running around, if you will, inefficiently looking at homes that aren't going to match what you wanted because you never got to see it. The beauty of today with the internet is you've already been in the home before you've been in the home online. So it's much more efficient in your house hunt. So you set up the search, we build that for you on the MLS. We ultimately view homes, we ultimately get one under contract. In a spring market, it's not uncommon to have multiple offers and to lose a couple homes along the way. In a very busy spring market in a very tight price range, you might lose a few. I had one couple, they lost 9 homes until we finally got one. It wasn't because they weren't willing to offer a decent amount. The problem was other people were willing to pay significantly more, even though we were 10% over. That was when the rates were back in the 2, 3, 4% range. We had a ton of people that could qualify and went out and bought houses. And because they could, you have more people, more competition. They bid outrageously high. Well, once we get a home under contract, we will. Then you call in the home inspector of your choice and or review the condominium documents if it's a condo or townhouse. I have a couple right now as I'm presenting to you. They are with their home inspector. They've been with them for the past couple of hours. So when we get off this call, I'll be conversing with them to see how it went. But what a home inspection is, it's usually about 3 hours. You meet the inspector. You've paid them to find problems. So they will. And they'll generate a report for you. The report's about 50 pages with pictures. It's a way for you to get to know your home and your future projects. It's not a time to come back and renegotiate with the seller. However, if you find something that's hazardous, meaning there's carbon monoxide or open electrical wires or something to that effect that makes it dangerous, then that's always a fair game. Or something that was unknown, like for example, maybe the sewer line, um, because you did a sewer line inspection, is collapsing and is not safe. Well, that was something nobody knew, and now we know, and that's something we would negotiate based on. So if something comes up during the home inspection that requires us to negotiate based on that, we will do it. Otherwise, you'll get to know your home and your future project list. With condominiums and townhouses, you have 10 days to review the rules, the regulations, and the bylaws and make sure that you can live under them. If you cannot, you can cancel and get all of your money back. And same during the inspection period. So if the couple that's looking at the home tonight, for whatever reason, even if the home is perfect, decide they don't want to go forward, they can cancel and receive all of their money back. So in Minnesota, through a home inspection and the condo doc review, you basically have a free look period. And that's, we don't want that to happen, but if it happens, it happens. And then we'll find you another one. After that period is over, then you tell the lender, hey, I'm good to go. Order the appraisal. They'll charge your credit card between $650 and $750. They'll order the appraisal, and that appraisal is for the lender to validate that the collateral, i.e. the house, is worth what you've agreed to pay for it. Title work is done so that we can be assured that you can actually get and be put into position as a first lien holder. So we want to make sure that whoever is selling it really has the ability to sell it to you. And 99.99% of the time, that is the case, but that's what they're checking. Then the loan is finalized. What they're verifying is that you're still on your job, you're still making what you said that you were, and that your credit and your debt ratio has remained the same. You can't go out and buy a new home and a new car at the same time, or you shouldn't put it that way, because it could affect your debt ratio and it could kick you out of that house. So sometimes people will make large expenditures, which will then disqualify from them from that house purchase. Now, 1 minute after you sign the papers, after the ink is dry and you've closed on your loan, go buy that new car or that new set of furniture or whatever else you want to buy. That's a large expenditure. But during the home search, remain relatively static. We don't want you to overextend yourself so it affects your purchase. Then, after everything is signed, you close on your new home. It takes about 45 minutes, and then you get to plan which holiday you're going to host with your friends and family. So that was a verbal description. Here's a graphic description of what I just said. So we're at the top here. We're at the top of the roof, getting educated. You're going to figure out what you can afford. You're going to get a loan. You're going to go out shopping. We're ultimately going to get a home under contract. You're going to have an inspection or inspections. There's 5 of them that you can do or more. And then finalizing the loan with the lender, go to the closing for about an hour and have your party. Then mistake number 1 is ignoring the programs. I'd mentioned earlier that you are a first-time buyer only once or every 3 years, depending if you own a home and then sold it and then sat out for a while. So with first-time buyer programs, they work perfectly with regular conventional or FHA loans. So conventional loans are created and purchased by quasi-government entities known as Freddie Mac and Fannie Mae. So they're the ones that create and buy and provide the liquidity for conventional loans. FHA is a government insured loan, as is VA. And down payment assistance programs overlay, meaning they sit right on top of these 2 programs. So it's an additional amount of money, a down payment assistance program, over and above a primary loan. So it's a second mortgage, a second lien, if you will. Here we say that a first-time buyer is somebody that hasn't owned a home for the last 3 years. So again, you may have somebody that you know of, family member or friend that used to own a home and doesn't have the money for a down payment. They're like, well, I don't have the money. You know, I wish I was a first-time buyer. You could say, hey, I just learned that you are a first-time buyer again, which means that they can utilize the first-time buyer programs. Most first-time buyer programs have a certificate component to them, meaning you have to take an online or in-person class. This class tonight does not qualify for that. It's usually 8 hours, and you get it from a place generally like Frameworks. That's one of the places, or some of the nonprofits that are authorized to teach it. And it's trying to teach you the basics of home ownership so that you don't get yourself in trouble. Lenders lend money. Lenders do not want to own real estate. So the goal is to have you be successful in your home ownership journey and not get foreclosed on. Nobody wins in a foreclosure. That's why they want you to take the class, stay in budget, and get pre-approved. So even though you may not want to take the 8-hour class, what I've had many people say to me is, boy, you know what? That was a good class. I am actually glad I took it. Now, if you do it online, you can come and go as you wish. So it's not as big a commitment. It's still 8 hours, but it's chunked, meaning you can do 2 hours today, 3 hours tomorrow, an hour the next day. But you don't want to take that class until you know which class is required for the loan that you want. So inadvertently, you could take, let's say, the frameworks class, only to find out that you had to take the PPL class and they don't work. One doesn't cancel the other. So now you got to take 2 of them. So the lender that you're working with and providing the down payment assistance to you, if that's what you're going to utilize, will tell you where you need to take your class. So you need to do that as part of this process. When you're working with a lender, and I can be your quarterback directing you, you're going to have to indicate what city or county or area that you want to buy, because the only program that's statewide is the Minnesota Housing Finance Agency, the MHFA program. Otherwise, there's individual programs for the respective cities. And sometimes you can stack them. So you may be able to get a county program with a city program. So one of the programs that we haven't quite talked about, it's the first generation program. And that I have a client using right now. She's getting 26,000 from that, and she's getting 5,000 from Washington County because she's first generation. So that's two programs, $31,000 of free money. Now, that's just one example. One of my loan officers was able to stack 4 programs for a person that wanted to buy a home. It was in North Minneapolis, and there were some different programs that were available specific to that area, in addition to the state programs. And Pete was able to stack them all up, so she got a boatload of money. But I have never seen in my career as many programs to help people get into home ownership as I have today. So if you're looking for money, we just have to decide where you want to look, and then I can start directing you on where I think it might be available for you. Here's a hypothetical example, but here's how it works. Of somebody utilizing the Minnesota Housing Finance Agency down payment assistance program with a regular mortgage and only putting $1,000 down. So the Minnesota Housing Finance Agency requires that you have $1,000 of your own money. Everything else can come from somewhere else, meaning it can come from the seller, it can come from a gift, it can be from the program itself. You can get up to $18,000 from this program. So in this example, we have a gal named Anita buying a house for $250,000. She's getting a mortgage for $242,500, which is 3% of the purchase. Her closing costs are roughly 2.5% or another $6,250. Total amount needed, $13,750. However, from her own money, herself, out of her pocket, she only needs $1,000 because she's going to borrow the $12,750 difference from the Minnesota Housing Finance Agency. So if you have a 640 to 650 credit score, you're going to qualify for most of the down payment assistance programs, and you can get in for as little as $1,000. Excuse me. There's various websites that you can go to look up where an address might qualify for it. And right within the multiple listing service, we have a link attached to the listings. So you see that little button where it has money right there and a checkbox? That's the button you push, or I push, and it opens up on that address, and it shows all of the down payment assistance programs that this property would qualify for. And this happens to be the listing where my buyer is getting the 26,000 and the 5,000. So there is a down payment research tool that matches by address. Some lenders have a proprietary program where it's their own money and they can do different things because it's their own money. So it's not a county program, not a city program, it's a lender program. So this is Patty, my wife. You do not have to use Patty, my wife, but she has a program called Dream Plan Home that can give you a credit of up to $5,000 for closing costs. And it's income dependent, and you have to be a first-time buyer. But there is this program that's available that's exclusive to Wells because it's Wells's money. Then there's different city programs. Now Woodbury has one, but at present they're out of money. We had hoped that they would have had enough money back in the program to fund that home that I just showed you. However, at present they don't. Same thing with the city of Edina. Edina has a program. It's called Come Home to Edina. You can get up to 25% of the purchase, not to exceed $90,000, and it's deferred, meaning you don't pay any payments until you sell the house. It's 1% simple, or I'm sorry, 5% simple interest, or 25% of your profit, whichever is less. But a lot of people think that the suburbs don't have programs like this, and they do. Minnetonka has one, Eden Prairie comes and goes, Woodbury does. So there's a lot of city-specific money that's available. At present, Edina is out of money, but that will change again in the future, and then they'll be able to continue to fund loans. Here's the MHFA rules. You can go right out to MHFA, Minnesota Housing Finance Agency, and look it up. Now you see over here where it says contact a participating lender. So this is very important. Not all lenders are approved to do MHFA loans. So if you went into ABC Credit Union or ABC Bank and you said, hey, I heard about this MHFA 18 up to 18,000, I only need $1,000 program. Can you tell me something about it? And if they say, we don't do that or whatever, then that means you might want to get up and leave and go find a different bank if this is the program that you decide works best for you. Because if that lender is not able to offer it to you, then you're never going to hear about it. That's why it's very important to tell your realtor, if they're knowledgeable, about where you want to be so that they can try to match you with the lender that will provide the program that you want, because not all lenders are approved to do all programs. And again, a great example is the Minnesota Housing Finance Agency. There's a list on their website of lenders. And then I know of lenders on that list that I work with well. But I mean, there's a whole list of them that are available to you if you want to pick your own. Otherwise, I can give you names as well. So this just gives you some more information about MHFA, and you can see their website right here, www.mnhousing.gov. Great resource. I had mentioned the first generation program. So this is a new program that was created this past year, and it came out of our surplus when we had a surplus. They carved out $150 million, and of that, the first tranche of 50 for the $35,000, that's gone. So that's all used up. But the $100 million program for the up to 32,000, that still has some money available. And they projected that they'll have money through October. Now, what is first generation? Well, it's somebody that hasn't owned a house. Their parents haven't owned a house, or if they did, they lost it in foreclosure. And they have to have income limitations. So in the Twin Cities, the aggregate family household can't be over $124,000. Now, if you look at loan forgiveness, what you see is that 20% is forgiven each year. So if you got this money and you got the full 32,000, after 5 years, it's all free because 20% is forgiven per year. So it's a heck of a deal. It provides a lot of equity in a short period of time. And in some families, we can stagger it. So one family I worked with, neither the parents nor their son had owned a home. So what we did is we had the son buy first. He utilized the $32,000 program. Then his parents bought second. So they both got the program. If the parents had bought first, then that would have disqualified him. So we had to stagger it, but we were able to get both of them that money. This program, when it disappears, may not come back in the future. We don't know because this was a one-time deal. If it comes back, it may look the same, it may look different. We just don't know. But there is some money available today on the $32,000 program. I'd mentioned the three types of mortgages that are generally used. The conventional mortgage, everybody can do that. FHA, everybody can do it, but VA, only veterans can do it. Are there any veterans on this call today? Okay, well, the VA program allows you to buy a home with nothing down. So it's a great program. If you're a veteran, you should take advantage of it or at least look at it. Underwriting guidelines can vary per lender. What they do is Fannie and Freddie and FHA have guidelines, but then the lenders can put an overlay, meaning they can make it tighter. You can't make it any looser, but they can make it tighter than the underlying guidelines. Maybe they don't want to take on so much risk, so they might require a higher credit score, for example. So you'll find some variance between the lenders on guidelines for FHA and for conventional. So if you're at the lower end of the credit spectrum and you would still like to buy a house and you're being told no because of your credit score, I might be able to tell you yes by directing you to a lender that doesn't have that same overlay. So again, having full disclosure, to your preferred realtor of choice so that they can direct you to the lender that might be able to provide that. Now, some companies only work with the in-house people, and I can promise you, if that's the case, that you're not going to be made aware of everything that was available. So I like to be a quarterback and have a number of sources that I can utilize rather than just one. And so I think that's beneficial to you, gets many more people into home ownership than if you just only can go with what the lender down the hall can provide. A conventional loan is not insured by the government. It's a quasi-government enterprise called Fannie Mae or Freddie Mac that creates it. And then there is insurance if you don't put 20% down, but that's private insurance. And you can be removed from that after generally 2 years, and you paid it down to 78%. So there is the ability to get removed from private mortgage insurance if you have a conventional loan, whereas FHA, it stays on. So FHA is a little more lenient with regards to credit scores. So somebody that may have had a credit issue in the past may be utilizing FHA because the guidelines are a little looser than conventional. And one isn't necessarily better than the other. FHA requires mortgage insurance, and the cost is really the same, regardless if you're an 850 credit score or 620. Whereas conventional loans, if you have a lower credit score, you're going to pay a lot more for your mortgage insurance. So what we tend to see is people with very high credit scores utilizing conventional loans and getting a lower cost of mortgage insurance than you do with FHA folks. But FHA, you can have a lower credit score. Now, most banks won't do anything less than 640, but there is no minimum credit score, and you hypothetically could get an FHA mortgage with a 500 credit score. Now, if you did, you'd have to put down a much larger down payment to offset that risk and have a reason why your credit was where it was. It could be medical bills. Maybe you lost your insurance, you had a medical problem, couldn't pay it, had a bankruptcy, those types of things. People actually can get an FHA loan after a year of being in Chapter 13. So if you were to declare bankruptcy, there's some options to get you into home ownership a little quicker through an FHA loan than a conventional loan. Also with FHA, the seller is allowed, not that they want to, but they're allowed to pay up to 6% of your closing costs. With a conventional loan, it's 3%, so just a little difference. FHA, again, if you're qualified, you're qualified. It's not really tied to your credit score for the mortgage insurance. The rate might be tied a little bit to it, but not the mortgage insurance. FHA allows for higher debt to income ratios. And you can get a 15 or a 30-year loan, whatever you might decide to do. Down payment assistance programs or grants work well with FHA. So you can use FHA and down payment assistance or conventional and down payment assistance. Here's another grid that kind of shows the difference. If you have very good credit scores, you can buy a home with conventional with as little as 3% down. FHA is more forgiving on credit. The debt ratios are about the same. They let you use about half of your income towards a house payment, inclusive of your long-term debt. What they don't want you to do is to overspend and get yourself in a position where you might lose that house. There's limitations on the size of the loan. So for example, if you wanted to buy a home over 530, you might not use FHA. You might use conventional because that's going to allow you to finance it, whereas FHA has a lower cap. Down payment assistance programs work well. You can get gifts. You can take loans from your 401k for the down payment. But what you can't do is borrow money from a credit card or from a bank specifically for the purchase of that home unless it's a down payment assistance loan. So you can't get borrowed money, but here's where you can find money for a down payment. So the first one is what we've been talking a lot about is the down payment assistance programs from the city or the counties or both. You can get a gift from a parent or a relative. You can take a 401k loan. Generally, it's the lesser of 50% or $50,000. You may have to prove a hardship or fill out some paperwork regarding that, but you know that it is a purchase, but yes, you can do that. If you have an IRA, you can take $10,000 out, not claim it with the penalty, but you still have to claim it as income. And again, if you're running a little short, we might be able to work the closing costs into the transaction and have the seller pay them. Now, they could just pay them, or we could raise the purchase price potentially for what the amount is that you need for your closing costs. What you can't use for a down payment is borrowed money in any form. You can't go to the bank and cash advance your credit card, and you can't borrow money from anybody other than a lender or a down payment assistance program. And you can't use mattress cash. So if you happen to work in, let's say, a service industry where you get tips, and maybe you got a shoebox full of hundreds, you can't walk in to the closing and dump your shoebox on the table. The money has to be introduced into the banking system and should be there at a minimum of 60 days in advance because they're going to require 2 months worth of your bank statements. And if you show a large cash infusion, they're going to need a letter of explanation. And it has to make sense. What they're concerned about is money laundering. So if you have a large amount of cash and you want to use that for your purchase, make sure you get it in as a deposit in your bank at least 2 months, if not 3 months, before you start your loan application. Buyer's eligibility, based on underwriter reviewing your ability to repay, your willingness to repay, and the collateral itself. So you have to have the income to support the payment. You have to have demonstrated that you do pay your bills, and that's what your credit score represents. And then the collateral, meaning the home has to be in good enough condition for the bank to place a loan against it. And that's the purpose of the appraisal, to validate the collateral, meaning that the home is worth what you've agreed and it's in a condition that's financeable. Okay, I'll take a short break. It doesn't have to be 5 minutes, but are there any questions anybody would like to ask me at this time? You can drop it in the chat or you can unmute yourself and ask it to me. And if there aren't any, then I'll just keep moving. So I'll hold on for a second. Anybody have anything? Okay, let's keep moving. Mistake number 2 is not getting pre-approved before you view homes. So we talked about what it takes to get a mortgage. You have to have credit, you have to have income, and you have to have some money for a down payment. But we also learned that you can have as little as $1,000 utilizing the MHFA program. So to get pre-qualified, they're going to pull a credit report. They're going to verify your income through your W-2s and your pay stubs. And they're going to look at your assets. That's the bank statements, your brokerage statements, whatever you might happen to have. The lender is determining, according to ratios from your income, what you can spend on a house. Tips for a easy or a simple loan approval is call us if you have questions so that we can answer them. The process will move as fast as you do. So if you start the loan application and you stop, so does the loan. So if you're supposed to upload something and you don't, nobody can go further until you do. So one of the things you want to do is follow the directions of your loan officer and provide them in a timely manner the things that you are requested of you. Another thing is to continue living in your current residence. Whenever there's change, that may affect your debt ratio, may affect other things. So during the process of home shopping, try to remain as static as you can, meaning keep doing everything you've been doing. Pay your mortgage on time or your rent. Continue to use your credit like you normally would. Keep working in the same industry and preferably same employer. Keep your insurances the same. Stay current, of course. Don't pay late on any of your accounts. And then have the expectation of having to provide lots of documentation. I often tease people and say, well, it's other than giving blood and urine, they did everything else, right? Because they are going to require lots of documentation. But until they get it, they can't finish up your file. So if you say, well, I don't want to do that, or I don't think they should, I don't think that's important, it goes back to the rule called the golden rule, but with a twist. So the golden rule with the twist is the man with the gold makes the rules. So if you want the bank to lend you the money, you have to follow their protocol. So it's not that painful. It's just providing lots of paperwork, which you might have to search around or request. What you don't want to do is do anything that changes your credit profile or changes your job status. So you don't make lots of purchases that are large, for example. You don't close anything on your credit that could increase your utilization rate and then lower your credit score because of it. So again, when you make that application, be who you are today through that process. After closing, do whatever the heck you want. Go buy another car, go buy three of them. But for the time being of buying the house, remain static. Pre-approvals can be quick. You can go online, probably get one right now while we're doing the class. However, that pre-approval is only good as the information that you entered in. And there's always a disclaimer in the approval letter, and it says, this information, garbage in, garbage out. It's only as good, this approval is only as good as what they put in. I didn't verify anything. So you want to be fully underwritten where things are verified so that your approval letter can be a fully underwritten approval. And if you're in a multiple offer, if I have one from a company or one from a buyer that utilized one of the online lenders that you would recognize that advertise on the radio that don't do any verification up front, that letter is not going to have as much weight as another letter from a lender where you've been fully underwritten and everything has been validated. So if you want that competitive advantage when making an offer, you want to do that with a fully underwritten approval. That also allows you to shop with confidence because here's your letter, go spend the money. You know you're good, everything's solid. Otherwise, you're kind of wondering, well, what if something comes up? What if they don't give me the money and you've already given notice on your apartment or whatever it might be? So we don't want that to be the case. So take a little extra time up front, reduce the angst down the road. And by being underwritten up front, one of the nice things is that you can then close in a shorter period of time. So not all the time, but sometimes a seller will say, you know what, I'll sell you my house if you can close in 30 days. Well, if you've already been underwritten, 2 weeks of the work is already done. So yeah, you could close in 30 days. You could close probably in 15 days. Not that you want to, but you could. And for the right house, you might be willing to do that. So get fully underwritten, I guess, is the message there. Okay, mistake number 3 is using the wrong lender. So as I mentioned a little earlier, not all banks work with down payment assistance programs. Now, if you have 20% down or 10% down and you don't want to use down payment assistance, no big deal. Then use whoever you want. But if you need down payment assistance and want to use it, then we need to match you with a lender that can actually get that for you. Many of the mortgage brokers and smaller institutions are not approved to provide the down payment assistance. So some of the smaller credit unions, some of the smaller banks can't do it. So I'm making you aware of it today so that you know what to ask and you know that it's out there. Again, you don't have to utilize it, but I want you to know about it so that it can be your choice. So figuring all this out is about balancing a number of different balls. It's juggling, what am I going to put for a down payment? Where do I want to live? What's my credit score like? How long am I going to live there? What type of property should I look at? So there's lots of variables that go into the search and into the counseling. And sometimes you may not know right off the bat. You might want to look at both or all three, for example. And we can set up multiple searches for you. So like, well, I want to look at townhouses over in Woodbury. Well, but I want to look at houses in South St. Paul. I want to look at, investment property in St. Paul. So we could have three different searches going all at one time if that was of interest to you. And then we can go, I like to go wide before I go narrow. So choose everything to look at and then start eliminating areas or property types as you become educated in what you want. So it's always free to look. Next thing is a 30-year fixed always the best option, or would you consider an adjustable rate mortgage? Now, 30-year fixed takes all the risk out of it, right? The payment is fixed, the rate is fixed, repayment amount is fixed. But because it is fixed and it's a 30-year commitment, the lender might charge a higher rate than they would for an adjustable rate mortgage. An adjustable rate mortgage is where you share the risk, meaning the mortgage is fixed for a period of years, generally 3 years, 5 years, 7 years, or 10 years, and then it adjusts. And it adjusts with what's called a margin and an index. So it adjusts off of adding a couple arbitrary numbers, either up or down. Now, in a higher interest rate environment like we're in today, the arms that have been adjusting have cost those borrowers more money than if they'd taken a fixed rate when it was 2, 3, 4. However, if you're in a higher rate environment and rates are going to come down, an arm then necessitates that you wouldn't have to refinance because it's happening essentially for you because your rate is adjusting during that adjustment period. So it's a matter of deciding how much risk or risk adverse you are and the length of time that you might want to be in the home. So again, that's where some of the counseling comes in on recommending products and programs that might match your goals. We also have rehab loans. So you might look at a house that's kind of scratch and dent, meaning it either needs a new kitchen or a new bathroom or new mechanicals, or there's something that just isn't the way you want it to be in that home. But other than that one or two things, it's great. It's in the school district I want. It's in, it's close to family and friends and work, but it just has the most atrocious kitchen. Well, you could take out a rehab loan. Money is placed in escrow for that work, and then draws are made to finish up that project. So it's a little bit more complicated than that, but that simplifies it. But just know that if you find the perfect property that isn't quite perfect, and you would buy it if it just had this, meaning a new kitchen or a new bathroom, we have a product for that. That's one of the rehab loans. And again, that product is limited on where you can get it. So you're not going to find that at all lenders because it's a lot more work. It's like doing the loan twice. And there's some work they have to do after closing to manage that escrow account where the money is being held for the rehab. So not all lenders will do this, but it absolutely exists as a product. Mistake number 4 is buying directly from a builder without realtor representation. So all the big builders work with the agents. So when we set up a search for you on the North Star MLS, all new construction is listed there. So that means M&I, Pulte, Lennar, D.R. Horton, they're all there. And we're allowed to show you their houses. But what they want us to do is to come over and bring you to that house. What they don't want you to do is to go through on an open house on a weekend and find the perfect home and then call up the agent and say, hey, I love this D.R. Horton home. What D.R. Horton wants us to do, as do all the others, is they want us to be the initiator. Now, we may have initiated it through the search for you, but they want us to walk in with you. So if you're going to buy new construction or if that's of interest, let us take you there and register you. Let us be the first introduction to that house. After that, you can go back multiple times once you're in the system. But they want to know that we were responsible for introducing you. And the only way they know that is if we register you on the initial meeting. It does not cost you any more to have representation. The agent that's sitting in the builder's model home represents the builder. The only way you get representation is if you have representation. And that goes back to what we have to do before we can show you any home, which is at the beginning of this PowerPoint where we went over the buyer contract. So if you want to look at new construction, we want to show you new construction. It's all available in MLS. And we are very, I think, value add in the sense of helping you compare the builders, the goodies they offer, and the locations. So I think it's worth having the representation. And if it isn't going to cost you, why wouldn't you? So again, this just says that the builder is represented by the salesperson in that model home that they're working, and you get representation if you bring us in, and then the builder pays us accordingly if you were to buy. The home price is the same to you regardless of what the builder's paying the agent. Okay, number 5, skipping a home inspection. Why it might make sense and why it might not. Okay, so first off, I and no agent should ever tell you to skip an inspection. That will always be your choice. But there may be times when you might feel comfortable, and I just say might because it's up to you. What an inspection does when you make an offer with an inspection is create a contingency. Meaning, I'll buy your home once I've gone through my inspection, and if I haven't or if we have negotiated accordingly, then I'll go forward. Now, if you're another buyer and you don't have a inspection contingency, that means you bought the house. So there is no maybe, it's I bought the house. So from a seller's perspective, if they're comparing offers, one offer has an inspection, one offer doesn't. The one that doesn't, all things being equal, will be given probably preference because it takes that risk out of it. Another time that you might not need to do an inspection, again, totally up to you, is if you're buying new construction. So when new construction happens, and throughout the construction process, the city has to sign off on various stages. So they look at the foundation, they look at the framing, they look at the plumbing, they look at the HVAC. So what they do is they send out the building inspector to sign off that each of those things meet their building code. So to have a home inspection on top of all of that might be redundant. But again, that's up to you. So a risk, if you do skip it, is that there's no recourse. So if you said, I'll buy your house, and later you move in and you go, oh my gosh, I didn't know there was this, that, and the other thing. There is no recourse because you bought it that way. You bought it effectively as it is. So you lose negotiating power if you don't include a home inspection. And you risk inheriting something that's, a hazard. You also miss having a forecast of a future repair cost because you won't have identified the problem from which to get the bids on how to solve that problem. And so you'll have limited recourse. So typically, most transactions do involve a home inspection, and that home inspection can be the basic home inspection. It can be a basic home inspection with radon, with a sewer line scope, with a chimney inspection, and a mold inspection. Now that's 5 different types of inspections. Most buyers don't do 5. Most buyers do 1, maybe 2 or 3. You can do all 5. You're going to be into it for about $2,000. That's why most people just stop at the basic home inspection. Maybe they'll throw radon on for 150, or if it's an older home, they might do the sewer line scope because the cost of repairing and digging up and replacing a sewer line can be between $15,000 and $20,000. So that might be a good one to use for older communities like Minneapolis, say, or St. Paul or South St. Paul, areas where the infrastructure, that sewer line, happens to be, 100 years old. So that might be something that you check for $300, and then if it's determined to be bad, then you can then shift that risk back to the seller. And mistake number 6, skipping the condo document review. Remember, in Minnesota, you have 10 days to review the rules, the regulations, the bylaws, and all financials. And your 10 days don't start until you've received all of those documents. So if you only got half of the documents, you got the rules but not the regulations, or the rules and the regulations but not the financials, your 10 days hasn't started. And remember, you have 10 days to walk away during that review period. So it's in the seller's best interest to get you those documents as quick as possible to start that clock. Now, you could waive your 10 days down to 3 days. And sometimes people can and do. And the reason they might is because the buyer or the seller of the home that they're buying wants to buy their next home. And they can't buy a home non-contingent if your home has an inspection period that's still ongoing, because that again creates the contingency. So if you say it, you know what, I can read these documents, I don't need 10 days, I can make my decision up in 3 days, then you may agree to shorten it. But again, that's by mutual agreement. You're not required to do that. A great website is the Attorney General's website, where you can read these publications that have these rules. And I have that website for you right in the middle of the page there. This is what the first page of that report looks like. It's a 4-page report, but this goes over the rules and the regulations regarding condos and townhouse purchases. When we build a search, it looks like this. So we go over to the right-hand side, we put in the number of bedrooms, the number of baths, the price. Then we go to the middle and we pick the area or areas that you want to look at. We can do all sorts of searches, meaning we can base it on school districts, we can base it on counties, we can do a map search, meaning we can pick your place of employment, we can draw a circle or our own freehand design, let's say 10 miles from your location of work. So the multiple listing service is wonderful. It allows us to organize all the data and create the database and list of homes for you. Now, I'd mentioned if we were in person tonight, if I was sitting across from you, I would have given you a hard copy of this book. But because we're doing this online, I'm going to give you an address where you can go ahead and read this book as a flip book. If we ever meet in person, I'll bring you a copy of this book. In the book, these are the table of contents and the topics that are covered. It's a great little book. And I also have a PDF that kind of compares renting to home ownership and why owning is important. You know, if you look at wealth creation, the average person has half their wealth in their retirement plan and the other half in the equity in their home. And that equity in their home happened accidentally, meaning they bought a house and it just appreciated. But imagine, you know, your parents or grandparents, if you took away half their wealth, what their retirement would look like. Be completely different. So today, the average home buyer is approximately 38 years old. When I bought my first home, I was 21 right out of college. I'm in my third home. And what I did is I bought, sold it, rolled over the equity, bought, sold it, rolled over the equity. But I was able to roll over a sizable amount of equity because I had started early. So that's why I'm encouraging you to consider home ownership at your earliest opportunity. The best time to buy a home was yesterday, and then after that, the next best time is tomorrow. If you're going to wait a year, and if homes, we don't know, but if they are going to appreciate, and if they appreciated at, let's say, 3%, that home, let's say if it was a $300,000 house, will cost you $9,000 more. So there is a cost associated with waiting, meaning it'll cost you more the longer you wait if homes go back and stay on their upward trajectory. And typically based on the cost of labor, land, and material also going up, homes will follow and be pulled up by that. I have other books and resources. I have investing books, I have selling books, and a downsizing book. So you're all here for the buyer class, but you might have friends or family that have an interest in another area within real estate, and I have a book for them. I also have a YouTube channel. And my YouTube channel, I go and I interview lenders and people that are ancillarily related to real estate and helping you with home ownership. So if you went out to YouTube, you could watch interviews about other things like we've talked about tonight. So hopefully you're feeling confident now, excited, and ready to get started. If you wanted my assistance, I would love to help you as your agent. You could book a time with me either by calling me, texting me, or going to my Calendly link, which is right here, minneapolis-stpaulhomes.net/book. And it's free to talk. So we would sit down, we would review how I might be able to help you. We could do it by Zoom like we're doing now. So it doesn't have to be in person, but eventually we're going to have to meet. So, I mean, if we're going to work together, but we could have a Zoom meeting, we could do it however you want to do it. Calendar looks something like this. You click a date and a time, and then it confirms it. And then I call you back or text you and say, yep, that's going to work. We don't discriminate. We want to get everybody in home ownership. We work with everybody, and if you're not quite ready today because of issues, meaning credit issues or job issues, it doesn't, it's not going to be that way forever. Meaning you might be in the penalty box for a year or two, but I can get you the lenders that can help prepare you so that you can go ahead and be homeownership ready within a year or two. So the good news is credit, if you had bad credit, it doesn't last forever if you do things to improve it, and you will be able to achieve home ownership in your future. I did something kind of fun here. I created a QR code. If you wanted to answer 7 quick questions on a survey, I will send you a travel certificate. Looks like this. What it is it's for discounted hotel room in Las Vegas. There is a cost associated with it. You pay the basically room tax and a small fee that the hotel charges. I think it's at the Westgate or the Rio. I think they go back and forth. But anyway, if you're interested in a travel certificate for about 2 minutes of your time, it does expire and there is a cost associated with activating it. So you don't want to do it unless you know you're going to actually use it. But um, I love Las Vegas. I go there a couple times a year. And so if you ever needed to create a tour itinerary, let me know. I'd love to sit down and talk Las Vegas with you. It's a lot of activities besides gambling. The parks are wonderful and just a lot of stuff you can do there. So that's my card. You can take a picture of it. Um, Everybody's going to get a copy of the recording. So you're going to be able to go back and review this again at your leisure. And so with that, I'm going to open it up to questions. Um, are there any questions I can answer for you tonight that I didn't answer that you'd like to talk about? Feel free to unmute or to type me in chat. No questions? Everybody knows what they want to do? Here we go. When will interest rates go back under 6%? Boy, if I knew that answer. I'll tell you what my crystal ball says. So my guess is 18 months. So if we talk about interest rates historically speaking over a 50-year time frame predominantly are between the ranges of 5 and 6. Right now we're in the mid sixes, mid to upper sixes. A year ago we were in the mid sevens to even 8. That's too high. Although I'll tell you, my second home, when I bought it, had an 11% interest rate. So historically speaking, um, very high rates are abnormal. Very low rates are abnormal. There's no historical basis in 2, 3, 4% mortgages. Now that went on for a long period of time, so people got used to that. But that was really a gift from God. It was not something that we really ever seen throughout history. 5, 6 is the norm. I think we're going through lots of changes right now in the world, and I think that the rates will be normalized and things will be stabilized in 18 months. So what I call it is date the rate, marry the home. So you could buy the home today at the higher rate And if I'm correct, if my prediction comes true and the rates drop, you'll have the opportunity to refinance and get yourself a lower rate. But if you wait to buy a home, let's say you say, okay, John said 18 months, I'm going to wait. So you wait 18 months, that means homes are going to go up. If they're appreciating at 3% per year, that home might cost you significantly more, depending on your price range, than you would have had to pay if you had bought today. And as rates drop, more people come into the market. Approximately 1 million people will come into the market when the rates drop 1%. Now that's across the nation, not just in Minnesota. But my point being is that if you wait for it to be sunshine and unicorns and everything to be perfect, you're going to have a lot more people to compete with. The best time to buy a home is when you have less people competing. Then you have less multiple offers and a better chance of getting that home that you want. So that's why I say the best time is when things are higher, there's more uncertainty, there's more fear. When everything is panned out and peaceful and great, which really doesn't happen very often, there's always something going on. But when things get more calm, for example, more people will be in the market and you'll end up paying more for that same house and you have delayed your home ownership experience by that length of time. So I would encourage you to do it sooner than later, whenever you're ready. And, if nothing else, meet with a lender of your choice, learn and see if you're mortgage ready and what's necessary, and then you can go forward or not. The other thing is you can get your approval in place and not buy a home, but actually have the search set up so that you're familiar with value in the market. And when you're ready, that's the time that you'll be able to buy, but you'll have a great understanding of what value is in various cities. So it's never too early to start looking, meaning watching the inventory so that you get familiar with the marketplace. Even if you're not ready for 18 months, I would get a drip set up, a drip search, so that you knew what value was in the communities that you want. Okay, we have a question. I saw on the slide something about employer assistance programs. I work for the city of St. Paul. Is this something likely for me? Okay. Uh, I'm not aware of the city of St. Paul having a proprietary program with, let's say, for example, Wells Fargo. But Wells Fargo does have some programs for unions. So if you're in a union working for the city, that union might be part of the Union Plus program. And what that does is that provides protection in the event of a foreclosure. So you're not foreclosed on if you're laid off and you get like a $500 gift card. So if you're in certain unions, you could utilize the Union Plus program. So that might be an option for you. But other large employers, like let's say 3M or other companies that do have a banking relationship and a relationship for their employees, at some of the larger banks, like the Wells Fargos and the US banks, may get you some incentive. And usually it's in the form of a gift card. There is an interesting thing that I didn't mention, but I'll mention it, is I'll mention Wells Fargo's program. If you have a large enough amount of assets, let's say you had $1 million that was transferred over to Wells Fargo at the time that you were getting your loan. So you transferred your investment advisor relationship. You actually, depending on the amount of assets that you transfer, they give you a discount in the mortgage rate. So if you decide that you want to consolidate from another bank or another brokerage, tell that, to a Wells Fargo loan officer, and you would get that affinity program to the extent that it was large enough. If it's 10,000 bucks, not going to happen. But if it's a large enough amount, that affinity program exists. Um, but I don't think there's anything specific to the city of St. Paul. You mentioned only down payment help. What about closing costs? Okay, yes, closing costs and down payment. The down payment assistance programs can be used for both, not just one. So if you can get a large enough amount, you can use it for both. The one example of Anita that I put up on the slide, she used it for both her closing costs and her down payment assistance. Is Wells Fargo the best bank option that can be applied to all DPA programs? Or is there another bank that you recommend? Wells Fargo is not the best program at present for all of the programs. They do some of the programs. There's two mortgage brokers that I utilize that have access to more down payment assistance programs than Wells does. Wells has some. They have their own proprietary Dream Plan home up to $5,000. Some of the other mortgage brokers have other programs. So, so the answer is no. Wells provides a ton, and they do a ton, but they don't do them all. And they don't do at present the Minnesota Housing Finance Agency program. So if that's the program that you want, at present, Wells is not doing that. So it just depends on what you need. That's why I say I can be a quarterback once I know what you need, what cities you need, what programs you need. I can say, okay, Preston over at Movement Mortgage, or I can say Pete over at Nations Lending, or depends on what you need. Okay, another question. With down payment help, what's a good resource to find options? State broker bank. Okay, well, I think a good resource is your realtor, because, at least for myself, I know I don't should say I know all the programs. There's probably one I don't know, but I know a lot of the programs and I know the resources and can direct you to the people that can help you. When I go back to who you should choose to help represent you, you want somebody that has longevity in the business. It doesn't have to be me, but it has to be somebody that knows what the heck they're doing. There's too many people that don't do enough production, that don't know what they're doing, and that don't have the resources, i.e., the part-timers, um, people that have been in the industry a short period of time, the company person that only refers in-house to their own people. They're not going to be the resource that you need. I'd showed you on that one slide where there was the button that you can click in the MLS to find all the mortgage programs. So you can call all those programs um, yourself and find out who the lenders are, but you have to have access to know which program is associated with that house, which means you have to work with an agent to click on that button. That's agent, it's on the agent side of things. So you would sit down with that person in their office, you'd pull up the list of homes. You'd say, okay, what about this home in St. Paul? You'd click on the little down payment assistance button. There's going to be 12 programs that are going to come up that are eligible. You're going to see if you're eligible against what the criteria are, and then you can call the number on that. So that's one way to do it. Another way is to work, you'd say, hey, John, I do want MHFA. I do want to buy a home with only $1,000. Okay, then I'm going to suggest maybe three different lenders, and that isn't going to be Wells Fargo because they're not doing that product. Or you may say, I don't need that program. What other program is available where I can get $5,000 or some credit? I might say, well, that would be when you might want to talk to Wells Fargo. So it really, and again, you can talk to two or three people. I'm happy to give you various names so that you can talk to them. I'm not a mortgage broker at present, so I would not be doing your loan. But I know who can do your loan. Um, any other questions? Okay, with down payment home. Okay, thank you. You're welcome. Happy to help, Nathan. Well, if there aren't any other questions, I'll go ahead and stop the recording.